All right, and we are back with Chris. I'm hiding behind this thing, Chris, but I'm coming. Give me 1
All
second.
right. The stream.
There I am. Yeah, I'm the stream now. I've become an android. Chris, you like my joke about semis down
Yep. Just
1.3%?
wait. Is this thing broken? I mean, it
Yeah,
got to be wrong. There's got to be an
no,
incorrect
just
data
tap
feed.
the screen. This
Yep.
literally happened yesterday. Nvidia was down. What the heck is this candle? That looks wrong.
Oh yeah. That can't be right.
But anyways, yeah, yesterday it was like the same story. Yesterday it was like down in the morning, and I was like, uh-oh, little downside, and then boom, right back into the green territory. So we'll see if we'll see if there's a repeat function here today. But I don't know. I even though this is down on the day here, Chris, I don't, and I'm speaking. I have a short position on the Russell right now, but I don't see
Okay.
a ton of follow through ahead of CPI unless I'm missing something. I think it's probably just going to wait until CPI, right?
Most likely. I think that so I had a discussion pretty much at length about just CPI, the Fed, big picture for the second half of the year. I wanted to actually jump into. So Frank and I talked about this yesterday. You had brought this up as well before you jumped off the stream yesterday. But I wanted to zoom in here and let's go to the last like 7 years, because what I kind of pinpointed on the inverted yield curve with the 3-month 10-year is I would be quite concerned if we go into Q4 this year and this is no longer inverted and we have a rough and tumble Q4. So back in 2000, 2001, October to December was a down quarter, and that proceeded to give us a pretty hard hit recession for the next year. 2007, 2008, we came out of the inversion. We had a down quarter in 2007, 2008, early quarter, and everything was down, making lower highs, lower lows. What kind of makes me nervous about this environment is if we zoom out and show that 34-year history, this is uncharted territory, right? That's what nobody really knows how this plays out, because yes, we had a recession. Yes, we had a recession. Yes, we had a recession. We had the downturns in the market that were very violent. This obviously was short-lived because we have the tools and resources to buy our way out and debt fuel these rallies. But this was ugly, and this was ugly. But this is, what do we do with this? What makes me nervous is if this thing comes out of the inverted territory. What I zoomed in on, and I'm going to share this with you. The average inversion to recession is 24 months. Okay. So when I zoomed down on the edge finder, this is what I thought was interesting. It's October of 2024. That would be 24 months. See this? So right here, like end of October 2022, that's when we started the inversion. So, and granted, it doesn't have to be on the nose 24 months. It could go to 30, 36 months. It could be longer than what we think. But at least it shows me like right now, this isn't the case as far as like the average recession, like post inversion. But 24 months is 24 months, and that's the average. And I could just see this market, surviving and shrugging off a lot of stuff until Q4. And then I'd be, like I said, if we see a bad Q4 this year, that gives me a lot of additional caution going into 2025. But if we see a solid Q4, it's kind of hanging on to everything until 2025 gets nasty.
Well, you're talking about an environment, Chris. If for that to let's think about what gets us out of the inversion kind of story, right? Because for those of you guys who are just tuning in, if you missed our conversation about this yesterday, we talked about how historically speaking, a inverted yield curve, which is basically long duration being less attractive than short duration bonds, right? Yields being inverted. When that happens, historically speaking, it has always led to, when it comes out of inversion, it has led to a recession every single time that it's done that in U.S. history. The point with saying that is that Chris is pointing out that we've stayed in this inversion for like the longest we've ever stayed,
500 plus days. Yep, longest.
So what does that tell you? So what is that? And the thing is, how does it come out of inversion? Well, this reverses. So this number, the yield offered by the 10-year goes down, right? And the
10-year goes up.
Sorry, yeah, it goes up.
Yep.
And this one goes down.
Yep.
And what causes that? Well, it causes the trust in the longer term duration to be diminished, right? I mean, this
Right.
this the kind of a confusing topic, but the long story short is TLT is an interesting one to watch on this, because if you see TLT start to really jump, would that be the catalyst? I mean, is that the same kind of timing that would cause that to uninvert, or would it go the other way?
Well, I think TLT going up is more of that's just a straight up safe haven play in my opinion. I think
Okay.
what makes this this is the concern. If we go to the US 10-year and we
Hmm.
notice what this period did for the markets when we rallied up to the top and we hit that 5% peak on the 10-year back in October 2023, that was actually the summer, August, September decline that we saw in
Mm.
2023 before we started ripping higher. And that was almost to the day, right? We peaked at this 10-year and we saw the bottom in the market that we've been a long ways away from. That bottom in October 2023 is 28, 35, 40% ago. It's a crazy run we've seen for that last well, I take it back. It's not that bad. What is that run from October 2023?
Hmm.
We're talking. I mean, it's not that far off, dude. That's a huge run, man. From here to current price, it is a 31% run. So yeah, it's a 30+% run. But you go back to that 10-year yield, and the 10-year yield has done virtually nothing off of this. It's like we had a relief rally in equities. We had a relief rally in the bond market, right? That's what prevented the bonds from going into a 3-year drawdown. But this has not nearly looked the same as the stock market. So that typical inverse correlation of if stocks are up, bonds are down, that's true right now. But
Hmm.
I do wonder if we start to see, in order for the yield curve to become normalized or uninverted, the question is the 10-year going to steepen? If the 10-year steepens and gets stronger, let's say that the 10-year revisits this 5% zone again, I don't know if we get beyond that. Like maybe I mean, because the 3-month is at, can you check the 3-month right now, Nick? Is it like 5.3? I
Let's
can
say
check it too. I think it's like 5.3.
5.25.
Okay, so 5.25 versus 4.41. So let's say that the 3-month doesn't do anything. Let's say the 3-month stays where it is. Well, does that mean that the 10-year is actually going to go to 5.25 or 5.3? Maybe. And if
Mm.
that's the case, we get out of this uninverted. But this did not bode well for stocks here. I would imagine it wouldn't bode well for stocks there either. So again, I just wanted to kind of follow up in this conversation because yesterday we showed like this is 2000, this is 2007 and 8, this is 2020, this is now. You know, we don't know what this looks like, but I think what makes me nervous is longest inverted yield curve in history. To me, tells me like the cycles and the acceleration that we see, something ugly could happen very quickly. And also, let's piggyback this on what's happening Wednesday with the Fed. The Fed has been very lucky over the last couple of years, even like the last 4 or 5 years, navigating through COVID, post COVID, navigating inflation, really having to do nothing other than raise rates and then sit and wait and not have to react. The Fed has been very lucky. And in your career and in my career, I rarely see that the consensus is the Fed got it right. Right?
Yep.
Usually it's the
Yep.
Fed is reactive to something and the Fed is breaking something or something is breaking for the Fed to then step in and put in a backstop.
Yep.
So that's this is big picture stuff, but it's like that's what makes me nervous about any type of chaos is that the Fed hasn't broken anything or the market hasn't seen anything break in and therefore nothing has to happen. And I just feel like the longer that goes on, the more violent a break ultimately becomes, whatever that is. And if it's the stock market, if it's the bond market, if it's commodities, if it's the dollar, if it's crypto, I don't know. But if something breaks, I think it's going to be ugly and crazy. And it could be, more violent than we've ever seen in the past because this is what happens when something just sits and boils and bubbles under the surface until it finally erupts.
Yep. Yeah, I mean, and that's the thing is I just think that when I look around, like where I want to, because you still have to, the thing is with being concerned about the big, drop that could come. The
Sure.
problem
Black
is,
swan.
it's like you can't always stay cash either. So what do you do? And for
Correct.
me, that's meant kind of allocating and staying allocated to gold. I know that's like I know that's like an area of the market that I like to kind of stay playing. And I think that
Yep.
gold is one of those things that looks foolish until it doesn't. And I
Hmm.
think that the scenario that you're talking about, gold may see a drop like it did in 2020 off of like the initial fears of recession, because everything gets sold in that instance. But the follow through in 2020 was remarkable. I mean, 2020, I believe that gold, at least for a large part of it, greatly outperformed the S&P 500 because the money printers came on, and you can see the drawdown here was only 15% compared to like a 30% drop.
I mean,
And
that's half.
then it just ripped back,
Yep.
so
Yep.
something to think about.
Yeah, for sure. And one thing that I think a little bit of this is dripping in because like Frank yesterday we were talking offline, and I think Frank's I'm just trying to keep his cynicism at bay because it's like, look, man, you can be right eventually, but
Sure.
it's not worth being bold enough to be like, I'm putting my foot in the ground. Here's a line in the sand. I am bearish. It's like you can be wrong, man, and it sucks to take a stance and take a direction and lose when it's like that's when your brain starts to go into like this doesn't make any sense. That's the
Right.
point.
Exactly.
It doesn't have to make sense. It's like as
And the
long as the
thing is,
market moves and does what it's supposed to, then we can make money.
even in my most bearish times, I still acknowledge that the S&P 500 is the 500 best companies. You're betting
It's true.
against
That's true.
innovation and strength. And can it get overdone to the upside? Sure. But
Yep.
still, I don't want to bet against the best players in the game.
Yep.
If I'm going to bet against stocks, I mean, for me, sometimes that means shorting the Russell. For most of the time, I don't even like to short indices in general. If I'm
Right.
bearish, usually what that means is selling covered calls against positions that I like, against sectors that I like, or maybe a sector rotation. There's other ways to be cautious than just
Yeah.
outright shorting the market. For me, that might mean sectors. It might mean taking a stab of small short size positions. It might mean selling covered calls. You can get pretty creative with finding ways to be defensive. I think defensive is different than being bearish, right? Defensive is just being cautious. And
Right.
for me, defensive might mean, again, sectors, or maybe I allocate more to gold, or maybe I get long commodities if I think, XYZ. So there's all different ways you can play it.
Yeah. So I took a look yesterday at every sector. I think that there's kind of a consensus that I'm building technically right now. Like we're stretched pretty long in the tooth in these bull markets. This run we've had through through January, February, March, a little pullback in April. Let me just share this with you. So the SPY, and I'm hoping this isn't too noisy for everybody watching, but I'm just going to share a couple of swings using fibs and what I could kind of project out in the bigger picture. So if we go back to this previous top in 2018, this is January 2018, to our broadening pattern here with the COVID crash low in March 2020, to all the way stretching up. So I take this high connected to this high. Now this channel, if I go, I'm going to circle all my levels here. So I've got resistance here, and then somewhere in this area, since this is current price. So anything up in here would be future resistance if the market continues to rally. That puts the S&P on pace for a 6,000, price point, or the 600 to 640 level on the SPY. That's way up there, and I'm not, even remotely thinking like, oh, it's gonna happen. There's no way. It can happen because technically it makes sense, and this would be absolute melt up if we get that to happen. That would blow through already, all the smartest banks in the world and all the big financial analysts have, changed their price targets to go higher, thinking, the S&P is going to be at 5,400 or 5,500. Look, 6,000, you don't see that number getting tossed around a lot, but it's there on the charts that I see. Now, at the same time, you take this low to this low to this low, and where does that project from current price? This is our support level. One of
Yep.
these two areas I think is very capable of getting hit. I would say that if we hit resistance, great. That's the melt up that keeps going, and that's the gift that keeps on giving, and everyone's, pensions and retirement accounts and the markets overall, everyone's happy. But if we get to that level, Nick, I am way more interested in being a bear at that time because it would make some sense. And then the flip side of that is if we see a correction, there's at least a level of pretty strong support to buy, as opposed to this thing break structure and like where does it go out here? It's in free. It's like I think this channel is at least technically sound. It's just a matter of, are we going to see something happen meaningfully, like directionally, or are we getting too preoccupied with it's got to go somewhere? It's like maybe it doesn't. Maybe
Yeah,
because it's already went pretty far for the last 5 months. Maybe sideways is all the market's going to give us. And this week could just be high, low, no direction, right? Spikes, wicks, noise. That can certainly be this week's trading. So that's what
sure.
I'm looking for.
Yeah, I think it's interesting, and we'll just have to see what the CPI brings. I mean,
Yeah.
do you have any guess on what the Fed is going to say tomorrow, Chris? What do you think? You think anything comes out of what they have to say?
Well, sure. I mean, I think that right now, I think if the Fed look, does the Fed want to job on the market? I don't know. Maybe, maybe not. I think that if we're staring at the graph of what's happened the last 6, 7, 8 prints of CPI year over year, this is sticky, right? It's like we're not really making any dramatic progress one way or the other. Now, I do think that this current Fed team is probably trying to prevent the second flare up of inflation like we've seen in previous years. Like when we had, the inflation flare ups in the 70s and the 80s, they all were up, they were aggressively lower, and then they flared up again. I think this go around, I feel like the Fed's job and possibly focus is to make sure that we don't have another flare up, because the flare up to cause a Fed backstop, to cause a Fed reaction, could get even worse, I think, or all of a sudden we go from 120% debt to GDP to 130, 140, and we try to print our way out of another crisis. Obviously, as a consumer standpoint, it's going to put so much strain on the consumer that I don't think we just get out of it in a month like we did during 2020. But I think that this CPI here, I mean, the classic accounting with the Fed is its core CPI, so you don't have food and energy. I mean,
Yeah,
that's still the most
that's the one that
unrealistic
hurts.
way. It's the unrealistic way to actually look at true inflation, because
Yeah,
with gas prices, with food prices, yes, I know things have come down, but last time I checked, stuff's more expensive. Fast food's more expensive, eating out's more expensive, groceries more expensive. I mean, it is what it is. Like it's the world we're living in right now. Now,
yeah,
wages are still growing, and everyone's sitting on household wealth that they haven't had in years. We're at like I think household wealth is going to hit like $160 trillion. And I hope that number is not off. I'm pretty sure I read that this weekend. But a lot of it's sitting in your house. I mean, I just said this morning, dude, I'm selling 2 houses in the last 4 years for
yeah.
about, I'm going to say about $400,000 of profit.
Not bad.
I'm in a market that's like, yeah, we've had some pretty crazy times the last 4 or 5 years, but making pretty good returns on just having a house. And I'm now in an environment where I'm out here with people in Utah that have been here for 5, 6, 7 years that are sitting on over 900 to $1 million in equity. If they sold their house, they're making $1 million profit. Okay. But the problem is, if they sell that $1 million house, that house was only worth $300,000 when they first bought it. To me,
Yep.
in my view, as a value trader or investor, it's like, I know what a $300,000 house looks like. It's that house that's being appraised at $1 million. That's not $1 million house, you
Right.
know. So it's a skewed look at like household wealth, and everyone's doing so well. It's like, not really. It's just it's sitting there, and like it's funny money in paper, that it sounds good, it looks good on
Yeah.
paper, but if you don't have real like money coming in or savings coming in, or you're not taking out a crazy interest loan on your house, it's like I'd hate to be in that environment where it looks good on paper, but it's paper rich and it's not actually wealth, you know?
Exactly. And that's the
So
thing is,
yeah,
there's just there's a lot of money that has been generated from, the inflation story, but as well as, financial markets being, high. That's another thing. I heard somebody talking about just how the Fed is looking to cut rates at an all-time high in the stock market, which is also kind of an interesting kind of couple, to see
yeah,
Fed cuts coming in or anticipated when the stock market itself is at all-time highs. Usually, it's like we were talking about earlier. Usually, they wait for some sort of sign, and that could be some of the cooling economic data that we've been seeing. I think you're seeing maybe some early signs of it. But will that be coupled with a stock market that actually starts to drop? Is that when they're going to start to rate cut? And if that is the case, and forecasts are on par, then maybe you're looking at a little bit of a bearish rotation for the next few months into
sure.
that rate cut. So I don't know. We'll have to see. Chris, I'm going to have to jump off here. I got to jump and do a podcast.
Okay.
So I'm gonna leave you to it.
Yeah.
But before I step out, I'm just gonna leave the show with Chris. Everybody, hang out with Chris for a little bit. He's got his own YouTube channel. We're gonna be dropping the link to that. He also has his own Twitter. If you guys would like to follow him on his socials, we'll drop those here in the chat. It's at Real Chris Pulver on Twitter, and his YouTube channel will drop the link. So Chris, you got it from here. We'll see you back tomorrow, man.
All
Big
right.
day
Thanks, Nick.
tomorrow.
Yeah,
See
big
ya.
day tomorrow for sure. Thanks. So to continue on with what Nick was talking about, I took a screenshot of this yesterday. I don't know. I think I did this when I was with Frank. I just want to take a snapshot and kind of acknowledge this is what the Fed rate tool is showing right now. So this is a CME Fed Watch tool, and the probability of a rate decision, not tomorrow, okay, not July, like nothing's going to happen. And so, we want to see what CPI does tomorrow. The forecast for the year over year is 3.4. I think that, a print lower, if it's 3.3, 3.2, okay, yippee skippy. But, the lowest that we saw here recently was 2.9, I believe. And then we've kind of, ticked up another 3/4 of 1%. This to me is what looks like sticky inflation at this time. Is the Fed comfortable with the 2 to 3% inflation reality? And look, you have to remember, we're sitting at 5.25 to 5.5% with the official cash rate from the Fed. Cutting rates by 25 basis points, even cutting rates over the next 1 to 2 years by 100 basis points, if we stay where we are with this economic data, call it true inflation or not, if our rate is 5%, 4.75, 4.5, 4.25, but our year-over-year inflation continues to print 3.4, 3.2, 3%, sub 3%. I think that's really a key level that the Fed is wanting to see. I truly think that the Fed wants to see CPI getting below 3% again to show that we're kind of on the right path towards deflation, right? But they keep talking about 2%, sub 2%. I think we are a long ways away. We're potentially, 1, 2, 3 years away from actually seeing sub 2% inflation again. So, the nice thing is we're seeing 3.4. The Fed fund rate is 5.25, 5.5. There's been no cuts at this time, but could the Fed afford to make a 25 basis points cut? Yes, they can cut 25 basis points, and really, that shouldn't change the fundamentals of the market. We're still at a restrictive rate. We're giving the market what it wants to see, which is the Fed actually showing that, okay, the pause cycle, we went from a crazy rate hike cycle to a pause cycle to now we're starting to cut rates. What's interesting that just happened last week, and you'll notice this in the Forex market, there's monetary policy divergence. Other central banks are cutting rates ahead of the Fed. So we now have the Swiss National Bank has cut rates, the European Central Bank has cut rates, the Bank of Canada has cut rates. If we start to see the Bank of England, the RBA, the Reserve Bank of Australia, or the Reserve Bank of New Zealand, if we start to see those banks cutting rates along with the Fed or pre-Fed, I mean, this is what makes that weird analysis of, is the dollar going to get stronger because it's still the last central bank standing to hold that pause cycle, right? This is the William Wallace, like, hold. And that's what the central bank is doing for the Fed compared to others. It makes the dollar more attractive. And we've seen the last 3 days, especially, it seems like the dollar index is holding some pretty strong support levels that, I have not been certain on what the dollar wants to do. I have been slightly tilted bullish on the dollar, okay? But seeing this level finally stand around 103.90, 103.85, I had this as my line in the sand. If the bears could break that level, I was willing to say, look, I think the dollar is going to get weaker, right? But the reality is, if we're holding that level and we have 3 days of bullishness, if this continues to go a little bit higher, this low, this was noisy, but it still bottomed out. And I could see the dollar getting back into these levels. Now, typically a dollar stronger move is not going to go well for the stock market. But in this current environment, we could see a weird correlation where the dollar gets stronger because the dollar is still the last central bank to holding policy longer than others. And that gets the dollar a little bit stronger. But at some point, when we want to see, aggressive risk on trading, maybe the dollar hits this level and we start to see a big fumble in the dollar. I think two big trades, and this is out there bigger picture wise, two big trades over the next probably 1 to 2 years. I think if we can spot a top on the dollar, it's going to be an incredible short. I would love to see even this position right here. If I was short the dollar, there's a lot of money to be made in the markets, right? You can make a killing in forex. You can make a killing, being a risk. I mean, this is a risk on rally, right? This drop in the dollar was a broad market rally for everything. You can make a lot of money trading, right? Um, so I think if it's this environment and we start to see a topping pattern on the dollar, I'd love to see the same type of thing. Now, let me zoom out here, okay? Because there's two ways that I'm watching this dollar index. Right now, if we have this running up here, to me, this is an inefficiency that can get filled. This is a slightly higher high where it's a bull trap, and then we look for a topping pattern at resistance. If this tops out, we go down to this level and we find this, critical kind of 101 level. But if we break and go below that, man, that's a monster trade on dollar weakness and everything like anti-dollar, everything possibly, risk on rally. And I don't know if that's going to happen, but I would say that would be a fantastic shorting opportunity if we get it. Okay. The flip side would be, okay, I can trade DXY. I can also trade the UUP. This is another way to look at the dollar trading stocks and options. This is a dollar-based ETF. I would love to look at this opportunity where we're up here. The dollar is still intact with a stronger move, a bull trend. But if we come up to this high or this high, and we start to notice that this thing starts to turn over, that perhaps we come back down to a fresh low. And so this becomes our kind of dollar trend. If this goes from, it doesn't seem like a lot, but if we go, let me just mark this as a percentage. If the dollar moves, let's say we're up here and we drop, I mean, that doesn't look like a lot, but that's about a 9 to 10% move in the dollar. That's a lot. I mean, obviously you can make more money trading futures. You can make more money trading Forex because they're leveraged markets. But even if I put in a 3 to 5% position, turn this into a decent chunk of profit. If I use options or I use a futures market, we can kind of, quadruple those gains, right? Maybe more. But you use leverage, you can make a lot of money there. It is going to be interesting how this dollar plays into risk on, risk off, how the bond market plays on risk off. I know, when I'm on the show with Nick, he typically mentions the TLT quite a bit. I'm long the TLT, but I went all the way out on my TLT timing to January of 2026. I went out all the way through 2025 and I'm into 2026 to say, I think if I give myself that time on the TLT that I can make some money on the bond market. I'm not trying to call, these big significant tops or bottoms. Look, I'm not interested in calling a top or bottom on the stock market. I'm not interested in calling a top or bottom in oil or in gold or in silver or in really anything. I'm certainly not interested in the Japanese yen calling a top or bottom, because another thing we have to watch out for is we're talking about dollar, and CPI and the Fed. The Bank of Japan is also this week on Thursday and Friday. It's that like 11 p.m. to 2 a.m. window from Thursday to Friday's trading. I'm talking Eastern time, but the BOJ right now, I mean, look at the dollar yen. We have only seen tons of manipulation in this currency. We've seen tons of manipulation by the Bank of Japan. I have lost all interest in trading the Japanese yen. I really have. And the reason why is it's not a technically obedient currency any longer. At this point, it's like you're waiting for the Bank of Japan to intervene. You're waiting for something, uglier to happen that is going to be something that's probably uncontrolled, where it's going to be slip, there's going to be wicks, there's going to be flash moves. That's not the type of Forex market I want to trade. I want to trade the technicals. I want to trade the boring stuff. I want to trade the pockets, the pivots, the overbought, oversold conditions. I want to trade a good, solid setup. You're guessing at maybe being right in the yen cross. And so even this morning, we were in my trading room this morning for the flex trading room, and I was up like 30, 40 pips on the New Zealand yen. And, I took the trade on a good technical setup. It was, maybe 60, 70, 80 pips of profit at one point. But I'm like, look, I'm not going to sit here and guess that I'm right. I don't want to move the stop to break even because it probably gets stopped out at break even. So I just took the 30, 40 pips. To me, this dollar yen trade or any yen cross, let's talk the next, 12 months. If this dollar yen is down here, I think there's a ton of downside potential, right? I think if the Swiss yen, I think technically could be a great trade. If the Swiss yen has an unraveling, we're talking about a currency that's at all-time highs, that if this thing sets up some type of, topping pattern, let's say it breaks back down here and gives us a crown pattern. If we have high, low, lower, high, lower, low, look, if you can line up, I don't know if anybody in this room has made a trade where the market in the Forex market moves over 1,000 pips in your direction. You can make an incredible amount of money, right? you take a standard lot position, even if you build it up over 3, 4, 5 trades, a standard lot position that nets you 1,000 pips. It's a pretty good chunk of profit. You know, if you're averaging a $10 pip at 1,000 pips of profit, you're looking at a $10,000 profit in one currency in one trade. It does happen. You know, in these yen crosses, if and when we get these setups, we could be talking about 2,000 to 3,000 pips. During the Great Financial Crisis, the yens were moving 5, 6, 7,000 pips. In 2012, they used 6, 7,000 pips. During COVID, we saw 3, 4,000 pips. 2022, with monetary policy, another 2, 3,000 pips. If you get just a fraction of that, it pays really well. The problem is, this is not something I want to anticipate, right? I don't want to anticipate this at all. So I will be waiting for the signs to get a chance to participate and then measure my moves and play my technicals and, you know, see how this materializes. But, you know, do I trade Forex? Probably. I'll take some stabs at Forex, but it's going to be with stop losses. It's going to be with reducing risk. It's going to be with moving stop losses to break even or better. I don't play games with the yen. I don't, you know, I don't believe that the yen behaves as obediently as others. When this yen wants to go somewhere, it does it in bull and bear flags. It goes, it pauses, it goes, it pauses, it goes, it pauses, and it will stay that way for months and months and months. And it drives traders crazy because the traders that like to fade overbought or oversold conditions get absolutely crushed. The traders that are trying to buy dips, they don't pull back deep enough to get a dip or retracement, drives traders crazy. So it's a lot of bear flags and bull flags. You got to trade, get your stop loss to break even or better, and let the thing rip. So anyway, Frank, let me answer one question, and let's dive into this. Text code asking, interested how your Swiss positions are going. Yeah, Swiss positions are fine. I took a stop loss last week on one of my systems, but I'm looking for it to get back in and confirm long. I'm still bullish on my Swiss pairs. Let me see. Overall, I'll log in and show you what we're doing. I'm probably at a net like 3,000 or 4,000 pips of profit, where I was up, you know, 7,000 pips of profit. So I'm still I'm still positive on the overall position. I'm still collecting some decent amounts of swap. I'll give you an example. Let me tell you. Give me like 30 seconds here, and I'll get logged in. So right here. Okay. So I will look and see. I'm probably up. I'll give you a number here. It's close to what's. So about 5. Okay, so I'm up about 5% in swap, and 5% swap's pretty good because I'm overall like my position size. Let me see here. So I've got. Actually, I'm closer to like 8% swap. Not bad. I'm up 8% swap. Let me go portfolio builder. No, I'm sorry, about a 5.5. I'm right, 5.5%. I'm up 5.5% swap by just holding. I'm currently sitting up around. I'm up about 15% net on my positions right now, and I haven't taken any profit. So I'm still building. I'm still waiting. Pullbacks are totally fine. I've actually added a couple of my positions on my Swiss crosses just to buy back in at a dip. So to answer your question, it's going well. It's a labor of love, and it's going to be a process, and it's going to take time. But I'm still highly convinced and highly, you know, stubborn on a little bit of these trades. But you know, I'm going to trade it where if I get in trouble, I'll scale out and scale back in. If I don't get into any trouble, then I just keep holding as is, and I keep adding to it on dips and pullbacks, and let them go to higher highs and ultimately hit my profit target. So when it's all said and done, you know, my goal is I'm trying to take an account, and I'm trying to double that account with just the Swiss crosses. That was the initial plan. I've done that for, you know, for 100 some traders that went into a course with me. And like I said, we're sitting up around like 11.4% right now. I'm sitting on about 5.5% of swap money, and I'm just going to let it continue to run. So if I really start to talk about taking profit, it's probably going to be at like that 40, 50% mark. If I take that account, go 40, 50% of profit, I'll probably take it. And then look to reestablish positions. Or, you know, to me, maybe that's my good enough. Maybe it's like, okay, look, I thought I'd get to 100%, but I'm at 50%. That's still really, really good. I mean, I started taking these trades heavy in like September of last year. So if I can do a year worth of Forex trading and have a 40 to 50% profit on a single account, that's pretty good. So anyway, all right, Frank, what it is, man? How you doing?
How's it going?
Good. What do you want to talk? You want to price out some earnings today? You want to do it together?
Yeah, let's do that. And also, I wanted to talk about inflation and where you think, you know, everything's going and what the Fed might say in different circumstances.
Okay. I will I can answer that. I'll give you like the minute elevator pitch on the inflation. So CPI data comes out tomorrow. What I think the market would love to see for a positive move, I think the market would like to see a less than 3.4 print year over year. I think that also gives the Fed the runway to maybe be a little bit more dovish for this meeting into that September rate decision. I think this also changes the Fed watch tool from roughly a 50-50 split to then the market really leaning towards that first rate cut in September. For me, I firmly believe that the Fed will not do anything in November. I think that would be madness if they did a November cut 2 days after the election. So to me, it's either there's going to be a tester cut in September just to pacify the markets, and then if all goes well and nothing breaks, then we possibly have another cut in December. But it will be interesting to see, can the market stay at these all-time highs and we cut during all-time highs, or does the Fed not have to cut because everything seems to be working as usual, right? We're humming along. We're in this Goldilocks market. The labor market's softening. But like you talked about, and we talked about this offline, there's look, the whole market right now is being carried by 10 stocks or less. And that's a really uneasy feeling to see that there's such a lack of participation and there's a lack of follow through in the broader market strength that it feels like this is unsustainable to have this much concentration. But that is also the design of a market cap weighted instrument. So I thought a lot about this since we talked yesterday. It's like, yes, the SPY, the QQQ, it doesn't make any sense that it's the same 3, 4, 5 stocks that are leading the charge and bringing us these all-time highs. But at the same time, that is just the cream rising to the top. That really is what it is. And I know that it's not sustainable necessarily, but it gives the broader market a chance to catch up. And maybe that equates to the bigger health of the market, or it doesn't. But to answer your question on the Fed, I mean, I think if we print lower than expected, that's probably going to let the market think, okay, Fed, give us the guidance, give us the dot plot. Let's see what the Fed rate decision path looks like over the next 12 to 24 months. And let's look at if the probability changes that there's a higher probability of a cut coming in September, that's probably getting priced in. That could lead to another melt up. I mean, you had mentioned yesterday that 450 or that 550 level on the SPY. I see the 545, the 555 window as well. So that could be the melt up. Also, it feels like everyone is talking about being bearish right now. Everyone's talking about, the market tipping over and being too overbought. If everyone's positioned that way, and I don't know what, I mean, do you have the COT? Is there any COT on actual like equities or index positions?
Yeah. So do you have it pulled up on your thing?
No. Is it on, you guys have it on Edgefinder, right?
Yeah, I can share
go
my
sentiment.
screen.
Yeah, go ahead. Share your screen.
So it's kind of weird. We saw a lot of buying in the tech stocks. So we got 2.7% increase on the net open positions on when you're accounting for long and short, there's more longs. But on the flip side, the S&P and the Dow are the biggest sellers of this week. If you take a look at the number of contracts too, is just it's kind of showing that money is just getting taken out of the equation. That's a 65,000 contracts gone, and then another 5,000 gone on the short side. But open interest really is not it's kind of showing that the demand for, I guess, assets has kind of gone away.
Mm-hmm.
And when you say things like everyone's talking about being bearish, I see a lot of people talking about bullishness too, and no one's talking. Well, from what I've seen on CNBC and other places, that no one's really talking about like a correction. They're all saying the market has like, a Tom Lee stance is at 5,500 for the S&P is plausible for the end of the month. Right. Which, I mean, I'm not going to rule out, but that's a lot of upside from here, and that's way further than what I would imagine we could run up to, and especially in a given month. But I'm seeing less bearishness than bullishness overall. I don't know if you have what have you been seeing that was bearish that people were talking about crashes and stuff?
No, nothing. I mean, that's the thing is I had a long conversation this morning about just being aware of these bigger underlying historically significant indicators like an inverted yield curve, like the recession timeline, like a carry trade and deleveraging, like an unwinding. These things take a lot of time to happen. And that's where I think, you can have that playing on repeat in your head, like this can happen, this can happen. But those take a lot longer than you think to actually be a reality. And so I think that's what's important to kind of compartmentalize the reality and the timeline of an unwinding. I mean, case in point would be the last time we saw a really massive deleveraging would have been the conversations with the Fed and being pretty transparent going into 2021 and 2022. The Fed for months and months and months was talking about raising interest rates, right? The market didn't really acknowledge any of that. And it got all the way into the end of the year at an all-time high at the time, until the reality set in, right? So
Right.
these things could be talked about, they could be making headlines, they could be stirring up all the drama, but it could still take months and months and months to actually line up and be the trade, right? And I just think that
You're right.
when it comes to being a bear in the stock market, if we aren't taking out, if we have high and high and high and high, and if the market doesn't adjust and break structure, we're crazy to think like we just have to bearish, because what are you trying to pick? You're trying to pick the top, the top, the top. That's the dumbest thing to do in a market that wants to go higher. Just let it. I mean, I mean, for most traders, it's a good problem. But if you want, like, for example, on Nvidia, if I'm getting filled on Nvidia at my $95 position like I took yesterday, if I'm too aggressive on my covered call on Nvidia, I'm going to lose out on 30, 40, $50 of upside. All I have to do is probably give it time, right? Do
Yeah.
we think that after a 10-to-1 split Nvidia, if it dips to, $100, $90, $80, that in time it can't be back up to $110, $120? I think everyone in this room, anyone watching that has seen Nvidia literally just blast off into its own stratosphere and be like a stock that can do no wrong. Sure, a reality check is needed for Nvidia, but that split and a little correction could go a long ways. And then you see that it's the second largest company in the world right now. I don't think that goes away overnight. If that is the case, then the S&P is doing an incredible disservice to every investor, because you let a stock like that rip the way that it does, and then it does what? It goes to zero? I don't think so. You can't have a company with that type of earnings, that type of margin, that type of head start, that type of everything that's positive and checking all these great boxes. It's going to be here for a little bit longer, and it's going to have maybe 2, 3, 4 quarters of more runway until competition heats up, until everyone starts to say, okay, look, Nvidia's been the only game in town, but now other tech giants are making their own chips and they're moving away from Nvidia, and it becomes competition. So
Well, I don't think Nvidia is going to zero. I don't think anyone
no,
does.
I don't
But
think it. Yeah,
what we're seeing here now is, it would be nice to call a top. Everyone wants to, sell at the highs.
right.
But it is pretty impossible to do. However, what we have now for this week could signify, I guess, for the SPY, 536, 537 could have been our high for now. Um, and what I'm kind of just hoping for is a pullback so we get, cheaper prices.
Yeah.
But inflation's going to have to come in sticky,
Yep.
or it's going to have to move higher.
Yep.
The Fed rate cut projections are going to have to be moved back further and further. And the confidence in, lower interest rates need to go down. But if that's not the case, this sort of setup right here, where you can see there is a head and shoulders pattern on the 1 hour chart, which is, it could suggest further lows, but every time we hit this lower low, it's like a broadening pattern too. So
It
we
is
hit
a
a
broadening
lower
pattern.
low on this trend line, corrects back up. So right now we have really no idea where this is going to go. But depending on what happens tomorrow, what the Fed says, what CPI says, that could determine whether or not this is our top for now, or
Yeah,
whether we're about to bust through this by the end of the week.
sure. And that's a good point. I'm going to take a slightly higher time frame stance because if I looked at a topping pattern, we'd have to take out this low around 518. I think if you go to a 4 hour or a daily chart, that 518 low, we'd have to come down and breach that for me to say, okay, I think the market is trying its best to put in a bit more of a top. Because to me, the broadening pattern is actually, um, if you switch over to my screen, I'll show you, and then Frank, you can take your I'd like your opinion on it, but there. So that's my broadening pattern. I'm starting, this area low to this area low to this high to this high. This is what I said. If we take out 518, that low would be putting us in trouble. Where then we all of a sudden we fade the rally, we sell the rally, and this could be like the scary correction. That to me is kind of worst case scenario. We come back down, we do some structural damage, we sell off, we test. This is the Apple gap we saw from a couple weeks back. This would be the April low that if we retest that, look, man, this would be a very volatile and an ugly market if we come back and take out April's low, but then somehow we justify another run to the highs. All it means is that if you're prepared for these highs and lows, chance to buy this dip could make another, 7, 8,
Yeah,
9, 10% rally. And that's
that's what I
good
was gonna
money
ask you.
opportunities.
I was gonna ask you if so say we hit that low, we break it, and I
Okay.
guess it's sort of the danger zone.
Yeah.
But I mean, would that be enough? Would higher CPI and extended elevated rates, would that be enough to sort of crumble the market, or does there have to
I
be
don't think
more of
so.
a fundamental crack? This is just we're talking about like a small correction
Agree.
uh, during the year, which is not going to be like a depression that people might be afraid of. But like, what
Yeah.
do you think?
I think I think this type of move where we're actually doing some major damage and giving back a lot of the gain. This would be back to resetting the entire gains for the year, by the way. If that were to happen, we're probably going into an escalated geopolitical environment. We'd have maybe a China-Taiwan situation. We have something much worse in the works other than like, well, inflation's sticky. It's like, okay, inflation's been sticky for 3 freaking years. It hasn't broken the market. We're sitting here talking about all-time highs for, 3 straight years. So I don't think it's that. I think that if we get, and this is an easy way to watch it, okay? Just like we talked about yesterday, this is last week's high. This is last week's low. If we hit the high, there is an 88% chance that it will not test the low. So that's why I'm
Yeah,
watching this so closely, because if we going into tomorrow's trading, yes, we have CPI data. Dude, CPI data in the morning coming out at 8:30 gets the futures market rocking and rolling, gets the pre-market levels moving a little bit. I have seen, $3, $4, $5 gaps coming into opening bell with the CPI day. And then on top of that, you get the FOMC the same day. It can be a very wild day. I mean, we could see if CPI data comes in lower, we could see this thing up to 538, 539, 540. I'm sorry, dude, but the Fed is probably not talking this market down any more than a little bit of a dip, right? If CPI
right.
data comes in higher and all of a sudden we're down pre-market, 530, 528, well, maybe we come after last week's low and that's going to be the threat for the week. So again, you kind of take it day by day. Like tomorrow, if I'm on session, I know I'll be on with an FOMC session with you guys. I'm probably going to look at positioning pre-Fed and just see what a 0 to 1 to 3 day expiration looks like, because we had much movement this week yet? No, we're in like a $2.50 range right now. The market should be moving about $11 to $12 in a given week with high volatility. So I think we can move, maybe $3, $4, $5 over the next couple of days. If nothing happens today, where it's just gap lower, come back to the middle, and we're just sitting here waiting for CPI, waiting for the Fed, then to me, the bigger play is we go up or we go down. We can get paid that way, just playing volatility for the next couple of days. So, but you're right. A correction, sure, makes sense. I'd like to see one myself, but at the same token, I don't think a correction on CPI and Fed talk is going to be enough to break the market. I think it is. I mean, when was the last Fed meeting that we had? Let's go. I'm trying to think when it would have been. We had a May. I thought we had a May one, right?
Pretty
Was it May
sure.
1st? Does that sound right? May 1st? Go
No,
back.
I'm not going to say anything yet. I'm just going to look it up.
Okay. May 1st, FOMC. Yeah, so May 1st. Let's go to that. Let's go to that timestamp. So May 1st, we had a combination of FOMC and we had Apple earnings on Thursday. Did the Fed do anything to disrupt the market? Yeah, intraday it disrupted the market, but what happened by the next couple of days? By Thursday, Friday, the market was up at higher highs. You know, so the Fed on May 1st was right here. Intraday, it was a crazy day. This was, we opened, okay? So May, yeah, this is May 1st. So we opened at, so this is a candlestick. So we opened here, had a slight low on the day, but we went up all, I do remember this now. We went up from 500 to 508. We went up $8 between intraday movement and the Fed pushing it higher. And then by the end of the day, closing bell, we pushed all the way back down to where we started. Crazy day, dude. An $8 move in a single day. That's 80% of the daily trading range or the weekly trading range. So yes, it's a noisy day. It's a very volatile day, but did it disrupt the market, do any structural damage? No. So going into this week's combination of CPI, FOMC, to me, structural damage to the downside would be we've got to take out these lows with a close, and we probably have to take out, maybe this 528 level as well. That's a $6 move to the downside. If we do real damage, it's down here below 518, in my opinion. We got to take out 518 to really look like, okay, the bears are not playing around. They're pretty serious. But if it's noise, I mean, dude, if the market just dips down $3-4 and dips up $3-4 or rips $6-7-8, that's a day that I want to trade. That's a day to be intraday trading. That's a day to be zero DTE trading. So if you like volatility, you're likely going to get it, and that's what I want to trade. So that's where I'm at for this week. I'm not going to. And look, this conversation that we can have, and we're speculating. What's the Fed going to say? What's the data going to show? Dude, we can have the most genius opinion that means absolutely nothing. So it's honestly better just to talk about what is likely going to happen, which I think is price volatility, and then let the dust settle, and then we can make an assessment to see, okay, does this start to make sense? Do factors in alignments like the Fed dot plot, does it start to change things? Does this rate decision probability change after Wednesday's close or Thursday's, Thursday, Friday this week? Does it change anything? If it does, cool. That gives me some data to go on. But
I'm not looking to predict. I'm just looking to cover scenarios so we can react in time.
For sure. Yeah.
But
yeah, and so let me ask you this. If the market goes down, and we talked about this a little bit yesterday, if the market goes down, what in your portfolio would possibly benefit from that? In your portfolio, if so, let's say the broad market goes down, what does your portfolio look like to benefit?
So I've had one DTE puts, and then I've had weekly puts. I have SPX puts that expire next week. I have I had SPY puts that expired on well, they didn't expire. I just closed them out on Monday because the market just opened down. So I'm taking these little these smaller profit returns on just these minor dips. And if it turns into a bigger one, then it'll work out really well. But other than that, I'm more so positioned to the upside. I'm just kind of trying to pad myself in the
Okay.
meantime. So I have these smaller options plays that if they're wrong, I don't lose that much. If I'm right, I don't make that much. But if I'm really right, then I make a lot. So that's kind of what I'm hoping for.
Okay, I'm typing out my scenarios right now. So if market is down, that's what I have kind of hedging, where I have a down play in the SPY, I have a down play in the Qs, I have an up play in the VIX. XLU's utilities, that's typically defensive, so I could still hold positions there. I took like a 90% take profit on one of my positions with XLU yesterday, and I repositioned for it. GLD and SLV, if we have a metals play or an anti-dollar play, perhaps that could be a reason to also see a resumed rally in those instruments. If the market is up, then I can go through. I've got probably 50 plus stock positions, but I don't need to list all those. But I would say my mag 7/Fab 4 can win. Those can be up. My broad bullish tilt can all drift higher. So I can see my overall portfolio be up, as opposed to can I weather the storm on profits to be made in the short term to offset a drawdown that would happen in the overall portfolio. Sure. I mean, I could probably make per account, I'd probably make close to 1, 2, 3, probably close to like $4,000 if we go down. If I have let's say those average accounts have like a $6, $8, $10,000 drawdown, well, it makes it less sucky. If I have $4,000 in profits, but I realize like a $10,000 drawdown, I can at least maintain that, and it's not making it as painful. If the market's up, then I still hold, and my broader market portfolio is up. I can still win on the SPY, the Qs, the DIA, the SPX, the NDX. I can win all my stock positions. My bullish tilt that I have, it's like that creates new watermark highs for me and everything. So yeah, I'd benefit in the up market. I'd benefit way more because everything goes up for the most part. So I'd see a bigger green number for my portfolio. But if the market goes down, I'm probably going to have a red day as far as my overall portfolio, but I'm making, kind of intraday, intra-week profits to offset some of that pain. Does that make sense?
Yeah.
So I mean, that's how I look at corrections. Like if I'm overall tilted bullish, I'm trying to make money in a correction environment, especially. I'm trying to make money to make sure that it's not putting too much pressure or pain on a drawdown. So I've got positions to work both ways. It's just, this is why we can talk neutral about everything, because like it really doesn't matter. I mean, regardless of what we want to happen, we're not in control of it. So whatever does happen tomorrow, whatever does happen by the rest of the week, what really matters is, did we have positions that allowed us to make money or not? So that's really the end game. Is as long as things are risk defined, you can take losses and move on, or you can make some wins and make some money and move on. You're still here trading tomorrow. You're still here trading next week and next year. And ultimately that's why we're doing this. It's like, it's just a week. And the nice thing is I would take a week like this where it's all the speculation and all the anticipation, but at least we know the market's going to move. To me, that's way more exciting and way more beneficial to position for than nothing is happening, right? To me, that's where things get really awkward. Is like, dude, this thing is low volume. I mean, here's where I would say this is the toughest environment for me. If I see the volatility index is down at these crazy lows, and it just stays there. The daily trading ranges are shrinking to nothing. The weekly trading ranges are shrinking to nothing. If all I can do is like, well, I got to put on a naked strangle to make some money, it's like, that is not the position that I want to take, especially in a low IV environment. That is just one bad volatility spike away from putting you into a lot of pain. So at least we have enough catalysts throughout. I mean, look, it's June, right? It's like, it's summer trading. People are on vacation. It's a little bit more passive. There's less volume, but there's still something at least exciting to have, traders trade, to have institutions, push price around a little bit. So that
But
to
you
me is
got
a
an
good thing.
iron condor going, right? On the
I
SPY?
I do. I think it's all the way up to 545. Let me check that I can log in. Let me check. I want to say that's out to July. Let me check.
You're positioning for volatility, and that's the play, I guess, to do it.
Yeah, so it looks like this. I have it. So this is that's my trade. So as long as, my 850 debit, as long as I can cover my 850 debit right here, then it's profit. Anything that moves, beyond that. So if and the nice thing is, because I went out and I paid for a little bit extra time, I do have some extrinsic value in the trade. So my time premium. And so if we get a big move this week, there is a chance that my 850 debit, even if we just move $7 or $8 in my direction, that could still be trading for $9 or $10 credit. So I can still turn it for profit.
Is this
But
for next week or a few weeks out?
I went out to the end of the month, man. I'm not trying to time this thing. I'm just like, look, if this is a reason to get the market to move, I mean, like I told you yesterday, I base this on the average move for the week is still $12.39. If the market finds a way to hit that for a high or a low, and we have a $12 stretch one way or the other, that's plenty of money for me to make, from an 850 debit to a $12 plus credit. I'm happy making that. That's 30, 40, 50% on that position. I'll take that every week, all week, without asking any questions. So would be nice is if it's a crazy move and I turn an $8 credit into a, a $16, $17, $18 credit. Or I'm sorry, $8 debit into like a $16 credit, because that's my max position. But again, I'm not holding my breath to want to see that happen. I mean, the last time I had a decent run, I took 3 trades in like 5 days and just repositioned this way, and I closed out like for $1, $1.50, $1.50 each time. and it probably added up to be about the same as if I were to hold it to completion. But it just was nicer to be like, take profit, reposition, take profit, reposition. And I just did that a few times. So some active trading.
So yours is an $8 debit. So you're hoping that it moves $8 either way.
Correct. So if I go to the weekly time frame, this is our weekly candle. So the week started, and I think I have a 536 and a 534, or I have a 534 and a 532. Just depends on, yeah. So right here. So I have a 534 on the call side, 532 on the put side. So I need this price, and you had mentioned 550. Well, that's a $16 upside. That caps my max move. I would turn an $850 into a $16 credit. I love that trade. If we get into the 547, 548, there's a chance this might be trading for close to $14, $15 a credit, which I'm totally happy with.
Yeah.
On the downside, 532, I need it to go to 524. That's why I looked at this 518 level. If we get to 518, that's another $5 or $6 on top of my needed move. So I'm happy to take $3, $4, $5 in net credit. One way or the other, as long as we have some decent volatility, this trade should pay. I've got the SPY, I've got the Qs, and the DIA will be interesting because this one has been kind of underperforming. But the DIA, if we have an up week, right? Up week, the DIA can kind of catch up and maybe make a nice little run to these highs again. If we have a down week, this is probably the one index that's the closest to doing some structural damage, right? If this is going to take out this low, let's say we go high, low, little pause, and we break that structure, that does some damage, but it also brings us right back into previous historical highs, which to me look like, I don't know. I still want to buy the dip. Maybe that's just me, but I'd still like to buy the dip on the Dow for longer term positioning.
Yeah.
So
I forgot we were supposed to cover earnings too.
Oh yeah, we were.
Do you still want to?
Look what we did. Yeah, let's do one together. I'm gonna do my trading room run 11:15. So let's get through one.
All right,
Let's
which
go to
one do you want to do?
Well, let's go to I would say Oracle, since that's the nearest run. This is today after market, so we can look at Oracle. I was looking at Oracle and Broadcom and Adobe, just because those are. I mean, Adobe's kind of in the AI space. I read something that the platforms, like if you use like Adobe Premiere or their editors or Photoshops, like they're putting in some type of like AI portion to it, and it's obviously good to like get into the AI space, or it's good to maybe help editors and maybe it makes them more productive and working faster. But it also could be like threatening positions because now, one person can do the job of several, perhaps. So again, take it or leave it. I don't know, but I think these are the three that I was kind of interested in. I did look at Vera Bradley. It's only a $7.50 stock, but numbers wise looks pretty good, but I'm not interested in taking an earnings play on a $7 stock that's going to move maybe 50 cents to $1 that you just can't price out good enough.
Yeah.
So anyway, let's look at Oracle because that's aftermarket today. And then Broadcom is aftermarket tomorrow. So we can do that one tomorrow. And then Adobe is aftermarket Thursday. So let's look at Oracle and let's go option slam and let's go simply Wall Street. So I'm going to look at ORCL. So snowflake analysis wise, Oracle has been checking a lot of boxes here. So yes, they have a high level of debt. That is a concern, but everything else, good company value, earnings are growing, forecasts to grow, trading at, if you discount cash flow model, you're looking at a fair value for Oracle around $187 and you're trading at 125. So if you're longer term based on future cash flows, we're looking at $40, $50 of upside, which obviously that'd be exciting if you have some shares of that. Let me go to the stock itself. Okay, we're trading in a pretty tight range, and I'd say the good side would be, we break off and we continue to head higher. I'd say the reality is that we've already made a run and that this is kind of contained, and this maybe disappoints and comes back to $100. But I don't know what the numbers give us as far as earnings potential. So I'll type it in right now. Let's price it out.
I'm gonna give it 10 points.
That's what you think?
I think it's gonna be 10.
Okay. Okay. Well, the average weekly move is $6.87. The average earnings report is, or it says 11.92, but that looks a little overdone. If I go into, let me log into Tasty and I'll see what their IV play is as well. So that stock might not have a high IV rank, which means selling premium might not be great. But it's 11.92 on the average move for earnings, but I see a lot less than that. I would probably go conservatively, Frank, I'd probably go 10 because we have a 10 down here, 9, 10 and a half, 10. These are the concerning ones is we've got the 6, the 6.5, the 5, the 7. Like if I'm saying that Oracle's going to move 10%, I can't see a 4% move and have like the way I want to trade it. It maybe doesn't make us any money, but I'm going to say 10%. So if we have a 10% move, how many times over the last 10 earnings prints have we did at least 10%? Let's find out. So I'll cut this off at an 8-day expiration. So we did it here. We did it here. We did it here. We got to 8.7 there. That's not good enough. We did not get it there. We did not get it there. We did get it there at day 5. Not too bad. We finally got the 10.7. This one we got there as well. And this one we got there as well. That's pretty good, man. We got 6 out of 10. So it's a little bit better than 0, right? So it's obviously better than 50-50. But 6 yeses to at least hit an expected move. And the nice thing is 10% is pretty conservative. So if I position for that, then if we get a 10% move, but we all of a sudden have an 11, 12, 13% move, makes my trade possibly easier. So I like the trade from that regard. If we did a 10% move and the stock is trading at 123, then you're looking for about a $12 to $13 move. So let me do this here. So I'll retype this. So the weekly ATR is at 687. 687. The average earnings is 10%. That's pretty conservative. So it says 11.92 is what the average is, but I'm going to say conservative. We're going 10. So 10% puts us around 12.38. And then if you take the full 11.92%, that's going to be a little bit higher number. So 0.1192 times 123.87. That's a 1476 move. All right. Okay. So that's what we're looking at right now. The weekly candle you can see has done mostly nothing. I mean, we've had a couple dollars up or down. So let me just take a look at it. So if I position here, let's go to Oracle. Let's see the IV rank and see what the expected move is here in the platform. ORCL. And let's take a look at the trade. So I would probably go out on Oracle to next week's expiration, not Friday. I'd go out to the 21st. And right now we're trading around 123.79. Let's just call it 124. Well, if I did a 125 and I did a 123, I'm going to pay $8.70 for a move that's expected to be 9.15. So we're getting the IV rank is actually pretty high, surprisingly high for a stock that's been sideways. But let's see what an at the money is. If I just did it right here at the money at 124, we're going to pay 9.62 for a 9.15 move, which means we're paying a slight premium. If I go one strike up, one strike down, I know that I'm giving the market a head start, but I reduce my cost a little bit by about $1. Now from here is where we get, our percentage move. I'm expecting to see, I think a $12 move is possible. Okay. So if I did a 125 and I do the 125 to 140, so I'll give it a $15 move, and then we have a 123 and I'll go 118. I'm sorry, 10. Hopefully there's the strike there. Fudge. I can't get a 108, so I can do a 110 or 105. I can do a 105. That give me a slightly. That's giving the bears more room, which is a good thing. But it's I'm not lowering the cost basis enough. Like this would take me down another 40 cents. So 740 on that debit versus 797. But if I'm right, I can give myself about $18 of max profit on the downside versus $15 max profit on the upside. This isn't a bad trade. Let me see here. So I guess the issue is like, can we get to 140, 150? I mean, if we take the trade at a 120, what do we go, 125? 125, can we get to 140? That's a $15 move, right? I mean, that pays for the, I mean, I'm looking at a debit here that's only going to cost me $7.80. I'll take the trade, dude. I'll take this trade. Let's see what we have. We've got enough, drama and volatility around it. I'll take a one risk trade on this. So I'm going to go 780. so I can cover the mid price. And let me throw this in. So I'm going to make sure this is the right account. 783, just do one contract. 780. Hopefully this fills. Filled at 780. Okay. So everyone's going to get a piece of this one. So this is my reverse iron condor 8051. Come on now. All right. I had to go up to 781. There we go. 634.
What if you went like 10 points out either way? So you had a 123 and a 124 buy call, and then you sell call out at 133, and then you sell put at like 114.
Let me price that out.
Right now it's saying 617 as the mid price.
Okay. So you're talking about the same expiration?
Yeah.
Okay. All right. So give me the strikes again. So give me the call side. What are you doing?
Call side is 124.
124.
And then you sell at 133.
133. So you go 9 out.
Yep. And then
okay.
You buy a put at 123.
Okay.
Sell a put at 114.
So nine each. Okay. So this is the good thing is it's a $6 debit for what's expecting to be a $9 move. The only reason I don't go super tight on my sell wings is because if we do see a move that's, let's say it goes, way lower. Well, in order for me to realize my $9 profit, I need to see price probably drop to like 108, 107, 106 for me to realize that full $9 profit if I'm going to have to wait for expiration. If I wait for expiration, then there's no problem. I'll make my $9, but it's got to stay there. The reason I go out wider and I'm willing, I mean, I paid $1.40 more, right? I paid $1.45, $1.50 more for my trade. And I'm giving myself, you're giving yourself $9 of max profit. I'm giving myself $15 and $18 of potential profit, right? Like, look at your trade right here. Your max loss is the whole debit and your max profit is capped at 280. Now your probability is higher than mine initially, but because these sell legs can get in the way and your trade, like kind of pound for pound, your trade costs a little bit more. Your max profit is a fraction of what mine is. Mine's like an $1,100 max profit for a 770 max risk, but I'm going wider.
Would you have to wait till expiration to?
I don't. You would. If you want $9 out of this one, you're gonna have to wait to expiration.
So,
or you're gonna have to see a massive move that's way beyond your sell strikes for that thing to max out.
So the further out you sell a call and sell a put, you can realize, say you get like a $9 gain on your 780 debit.
Yep.
You can realize that on the first day, is what you're saying?
Yes. So if we see a $9 or $10 move, I should be able to see a $9 or $10 credit.
Okay.
So I can close that trade out for like $1, $2 credit faster than you could because your sell wings are a little bit closer.
Okay.
Yeah.
I got you.
Okay.
Yeah, I'll think about taking that play. I don't know though.
Yeah, I mean, I'm in it. I like it. I'm gonna throw it in my tracker right here, and then we'll wrap things up. I got a couple more minutes before I have to start the trading room, but let me just throw this in. So I'm glad we did this one. I think it's a decent one. If we come back into another morning session, or I'll share this with you offline, but I will price out Broadcom and I will price out Adobe. I might actually consider doing them today because this is kind of a noisy week with CPI and with the Fed and with the earnings report. So for those particular stocks, if I go out to next week, the 21st, there's enough volatility to be, earnings matters, but also all the peripheral noise with CPI and Fed. Maybe it's better if I get positioned for them now because they won't be as disrupted going into Wednesday. So if I don't get them priced today, then certainly I will be looking to play these if I like them tomorrow morning. But if I get it priced today, and the market gaps up or gaps down with CPI in the morning, then I can already start getting the trades to shuffle around, and that's a good thing. I want to be positioned like essentially neutral today, and then let the CPI data, let the Fed, just let it move the market. And as long as it moves and earnings are another catalyst, good or bad, hopefully there's enough volatility just to make the move. That's all it is. All I need to see for earnings, especially, is like if we hit the expected move, I make money. So that's it. But yeah, I'll price these out. I think these are good.
Cool. Well,
and I'll share them with you.
sounds good. Yeah. I
All right,
guess
man.
we'll talk about this tomorrow on the big day.
Yeah, that's tomorrow will be a big day. So everyone watching, thanks for tuning in. Make sure you like and subscribe and all that good stuff that you're supposed to do to help the channel, help the algorithm, and support the A1 trading team. And look, I think this content is great and a lot of fun. I see Nick's head floating around. That's awesome. Frank, thanks for jumping in, man. I love it. Love having the co-hosts. It's fun.
Thanks.
Cool.
Thanks
All right,
for
everybody.
everyone.
Have a good day. See ya.